They want the money, and they're going to get this money, and they're going to plug the hole. And this itself was one of the, I won't say fears that I had when Trump came in. I thought Trump was going to come in and do exactly that and just take the money, right? But he didn't begin this way. He began in a different way. And now he's actually sort of found a way to take the money. This is sort of government spending coming down, net. And what is government spending coming down? That is deflationary. It's not inflationary. I mean, everyone says, oh, tariffs inflationary. It is a big deflationary problem.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck? Welcome, ladies and gentlemen, to another issue of the Grey Market Talk with my good friend Nicolas Themistocles. Say hello, Nick.
Bonjour, hello.
And a former market maker for options who is speaking to Nick. Nick, say hello again.
Hello again.
Every time when I want to find out what's really going on in the market. For everybody who is here the first time, what is this Grey Market Talk? It's two semi-retired, because you never retire from something you love. You just stop working for somebody else and work for yourself. Market gentlemen who've seen a couple of rodeos in this market talking about what's going to happen, most likely in the future, what's not going to happen, what's the narrative on the street. I'm Thorsten Wegener. I used to be an option market maker in my former life. I retired, now it's 15 years ago, bloody hell, Nick, as a derivative specialist and partner at Bear Stearns. By trade, I'm a trained market maker. I used to sit in front of the screens trading options back and forth and back and forth. And Nick did pretty much everything I did, but additionally he made a career and was the chief investment officer at a huge asset manager with over 60 billion US dollars in assets under management. Did I get that correct, Nick?
Yeah, very close.
Very close. Okay, it's more to the region of 70, but he tries to be modest. Anyway, so as I'm a market maker and I have to give prices all the time, bids and offers, I don't care the direction of the markets. I just have to know what my clients are doing. Yeah? What is the narrative they are playing to be informed, to be able to make prices. So if I want to get an idea what's going on, I speak to Nick. And Nick, let's start with that. At the moment, what are we going to see? A cracker boom, or is it the calm before the storm? Because I hear both opinions all over the place at the moment.
Well, both opinions are probably right then. I think this is definitely a calm. I think there's definitely going to come a storm, but I think the storm is probably not till next year. And we kind of talked about that earlier in some videos about the cycles and, the 18-year cycle, the real estate cycle and all of this stuff. And everything seems to be heading towards this 2026 level as a point where, the good stuff probably peaks. And therefore, you're supposed to enjoy the last bit of euphoria in all markets until then. And I think, we are coming to the end of a lot of these cycles. And, if we think about the biggest speculative cycle, and it's the Bitcoin, where is Bitcoin going? Because that's the risk asset, that's the risk on asset. So if you know where Bitcoin's going, you kind of get a feeling for what the temperature is on, the risk appetite around the world. And I think, Bitcoin's still good. Bitcoin's still got, a positive cycle, but we're coming to the end of that cycle, at least, as I've been looking at this thing, at least also in the way that the foundation of the study of cycles look at this thing. It basically says it's somewhere between now and October or thereabouts, that's coming to an end, and therefore, enjoy the rally whilst it's still there, but don't sit there and do nothing. At the end, you have to take your profit at some point.
When you talk about cycles, my first question is always, there are a variety of cycles. Little cycles,
Correct.
Medium cycles, big
Correct.
cycles, all together. One is showing up, one is showing down. What's your take on Bitcoin here?
Yeah, that's absolutely right. I mean, there's cycles always interact, and there are a multitude of cycles. and you're doing well when all cycles point in one direction. Then the call is a lot easier. When cycles, one goes up and one goes down, if you like, you say, well, which one is actually dominating at the moment? That's always very difficult. You can try and add the two together or whatever and say there's an average, but there's always something that's going to dominate. And for me, this Bitcoin thing has been fairly well behaved. The Foundation of Study of Cycles came out with a view that since the beginning of Bitcoin, the Bitcoin has 5 200-day positive cycles and 3 200-day negative cycles. So 5 positive and then 3 negative, then 5 positive, then 3 negative. And where we are in that cycle analysis, we are in the 5th cycle, and that peak in the cycle is near or damn it where we are now. And that you could argue left or right by 3 months, and that's why I say till October. And then there's the other way of looking at the cycle, and I'm not sure if I showed it in one of my videos, but again, if you look from the trough to the peak of Bitcoin, the very first trough to peak was something like 174 weeks. And then the next trough to peak was 150 weeks, and the next one was 150 weeks. And so if you look at where we are now, the 150-week end from the trough to where the theoretical peak might be, if you say it's going to be 150 weeks, is also coming in around October. So that kind of fits with the cycle analysis of the 200-day. That fits with prior Bitcoin cycles, not the first one, but the second and the third. So we are, we're at the point where I think a lot of things are pointing to some negativity down the road. And actually what we're seeing is in this phase of the Bitcoin rally, we're not seeing necessarily negativity as we're coming to potentially a peak in Bitcoin. Don't know if that's right, that there is a peak, but we are seeing a fall or tendency to peak in the Bitcoin dominance. And what that's allowing is, for, I must say, the first time in an awful long time, is a recovery in some of these altcoins, Ripple, Cardano, Ethereum, Solana, and that kind of stuff. So we're seeing a window of outperformance at the moment, looks like, in some of these other crypto assets.
There's a high correlation between the Nasdaq and the Bitcoin, at least in the past. We always have to say what happened in the past. Yeah? So if you're assuming that Bitcoin is running towards the end of the cycle, does that also give you an implication about what the general market now in terms of Nasdaq is going to do, or could we see a break of that correlation?
Well, I must say I've looked for a break in that correlation for a long time. We haven't actually really seen a break in that correlation. It's all about liquidity, I guess, and it's all about risk appetite and so on. And so the two are fairly well connected, and it would fit when we start to say, well, okay, potentially at the beginning of next year, risk appetite is going to run into some headwinds. And whether that means NASDAQ runs into headwinds at the end of this year and the rest of the market runs into headwinds at the beginning of next year is quite feasible, I would say. So, that would kind of fit with the view that, risk on is, it's all quite linked at the moment, and it's actually always been linked. It's all about liquidity. If there's money there, people just buy stuff. I mean, look at what's going on with silver right now. Is there silver is going up. Why did I buy silver? So I bought silver not because I suddenly believed silver is going to be the monetary asset of all things. No, you say, well, gold's gone up an awful lot. The silver ratio has gone to 100. Silver's a bit cheap. Same thing. Bitcoin's gone up. Oh, the altcoins have held back. They're a bit cheap. So people are kind of saying, well, okay, I mean, I need to keep in this game. These things, potentially these other assets like gold and perhaps Bitcoin, are sort of slow at the moment. So they start to pick the secondary assets. They start to pick silver. They start to pick altcoins. It's the same thing.
You just mentioned the big L word, liquidity, which would have been my next question anyway. Where are we at the moment, Nick? Because I also hear contradicting opinions. On the one side, you see retailers shifting in and everybody is putting money into call options and greed is going up again. On the other side, I got a statistic last week that Ekman produced that cash parked in money market funds is at an incredible high. Yeah, there is so much money on the sidelines. Is everybody preparing again for let's go and buy the dip? Let's hope the dip comes. The dip doesn't come, and the market is moving gradually higher and higher and higher.
Or the other way to look at that is people are getting nervous and taking money off the table and putting it in money market funds. You can read that one whatever way you want. But
Yeah,
you know,
but
if
these
you
are
look at
usually the guys who buy then Nvidia when it's at 5 trillion because they missed the next move. Eh?
yeah, I mean that's another classic example, isn't it? Really. So they missed out on Nvidia, so they go and buy AMD now. And they've been watching this thing for a while. Everyone's kind of piling into secondary assets right now because they, as you say, they've probably missed the big move in the primary asset, and so they're all looking for stuff which hasn't moved. They're all wanting to catch up, and that's leading to a lot of this speculation. And you see it if you look at X, you see the same names being primed. Got to buy Oscar, got to buy this Hims, got to buy. It's the same names. It's the same retail market that's piling in. There's very little about the fundamentals of these companies. It's just about this going to 50 soon and stuff like this, and you really get the feeling that we're in that kind of melt up euphoric phase in the market, which usually sort of says, okay, you're going to be right for a while if you do that, but remember to take stuff off the table at a later date. And I must say that's kind of what I'm doing right now myself. Is at the moment I would say I'm fairly neutral. I'm waiting. It feels like November again, where there's a lot of uncertainty in the market because, again, we got tariff talk. Again, we got, are we going to replace the Fed chairman and so on and so forth? So you got to say, what are the implications? And how's the market going to react to all of this stuff? At the moment, the market's kind of pretty chilled and say, you used to care an awful lot about tariffs. That doesn't give a damn, 30% for Europe, 35% for Canada, 50% for Brazil, 50% for copper. If these things were coming out in April, the market would have gone nuts. Now it's just saying, take it in my stride. We're going to get rid of Fed chairman. Don't care. Market's going up. Let's just. And the whole mood has kind of shifted right now, and that kind of leads potentially into some complacency. So looking for a small literary retracement, but ultimately the market still has enough momentum, as I say, till at least to the end of the year, perhaps early next year, to see it, still some more upside in the rally.
What's the difference between the market here and the economy on the other side? Economy talking about the US economy, because people like us, and I find that very interesting. The bloody retailers, I use it deliberately, are smarter than the smart money at the moment. Yeah? They see a dip, they buy it, and they participate. And people who look at the economy, the usual econometric models, the cycles are saying, be careful, inflation is not over yet. And the retailers are winning. They are right. Yeah? Price goes up, buy. Price is higher, buy a little bit more. So far, they haven't been burned. So this old adage like, oh yeah, well, smart money is here and we are feeding the market, it's complete rubbish in my eyes at the moment. Am I completely wrong there? Are they being tricked in, or are they just have become smarter because we're living in a different world, right? In the olden days, we remember that we had 10 guys with brains the size of, I don't know, an alien sitting in a room doing stuff. And now you can do it on your Excel spreadsheet at home with the help of Grok or ChatGPT or Perplexity or whatever. So it's just the playing field completely leveled, and the retailers simply see what's in front of them and they do it. And people like us are overthinking the whole situation.
I think overthinking is probably right, but I mean, nobody knows who's going to be right in the end. I mean, if you remember, I was looking for a sell-off in the market in November, December, January last year. It certainly didn't come. And then in February, March, the market started to peak and collapsed in a really fast way. I mean, you couldn't get rid of this stuff. And then suddenly the market is now in a positive environment. So, people, they're momentum players, it looks like. Market goes down, they sell, market goes up, they buy. And is there any reason at the moment for the retailers to get out of this stuff? to be honest with you, don't know the mentality of how they think. At the moment, they're not fussed by anything.
We had this conversation that eventually the retailer would, or the normal man on the street would run out of money, couldn't afford spending anymore. That would have an impact on corporate earnings. They are valued relatively high, and it would all fall apart. I still believe in that logic chain we're building there. It's just a question of timing. And you said, I think in our last conversation, yeah, they simply don't stop spending, the Americans. They
Yeah.
always seem to have money to spend stuff.
Yeah, I mean that's correct, but that's also cyclically. You can probably follow the cycles in consumer spending. There are waves of this thing, waves when they go all in, and waves when they pull back. And at the moment, I must say, so if we sort of come back down to fundamentals, what is this all? Are companies making money? Yes. Is company earnings are company earnings growing at a reasonable pace? They are. The question
Yeah,
is, they have definitely slowed I would say for this year. Nevertheless, the expectations from analysts are that company earnings will continue to grow next year. Whether that happens or not, I don't know. But this year's estimates for earnings growth has certainly been scaled back a little bit. So because there is this uncertainty, tariffs and so on and so forth. But I think that the analysts have left their positive outlook for next year. We don't know whether that's going to play out. We don't know whether this whole capex cycle for AI is going to continue. We don't know whether the people who have spent money on AI are going to receive some returns on this thing, or whether they have to scale back on their capex spending, because that's kind of the driver at the moment for what's going on with the corporate world. And then we've got sort of things that we need to focus on. What's happening with interest rates, and is it showing us something about the economy? And I must say, the interest rates are sort of kept in a. I see them at the moment as in a sort of 4 to 4.5% range in the US. There is every time it gets to one end of the range or the other end of
yeah.
the range, it looks pretty scary. When it goes quite high, it looks like we're off to 5%. And when it goes back down, we say, oh, recession and all of this stuff. At the moment, I don't think necessarily we're getting big clues from the interest rate market. And also, there's a lot of confusion about interest rates right now. Should interest rates come down? What would that mean for the economy? Is that a good thing? Is that a bad thing? And at the moment, I get the feeling that the Fed are playing more politics than they are playing the job that they're supposed to do, which is, if there's no inflation, and there's no inflation, if you look at the last
A
CPI,
great start, yeah.
PCE, we're there or thereabouts annualized at the target. So what's your excuse, guys? And then they say, oh, tariffs. And I think it's already been shown that tariffs, and if we've discussed this, in my view, tariffs are not an inflationary thing. They are a temporary thing. They are a relative value thing, but then it's nothing to do with monetary inflation at all. Nevertheless, they use it as an excuse to. So then you'd say, okay, well, sooner or later, the government, if they truly want to control the economy, they've got to control the Fed. So this idea about an independent Fed is, for me, it's coming to an end. And I think that's, these are the stories that we have to think about. What does this all mean? And I think it's part of the reality of the huge amount of debt that's out there. Governments need to be much more in control of what's going on. So we look at the UK. The UK are in a desperate sort of mess. They had a 5 billion, they wanted to cut something by 5 billion. There were some riots. They said, no, you can't do that. So the government said, okay, good idea. We don't do that. The gilt market goes haywire. And it's like, so what does this really mean? You've got the central bank just sitting there, kind of looking at this thing as if, they have no involvement whatsoever. And I think the reality is government needs to be much more involved in a lot of these decisions. And, what we see already in the UK, and already I've mentioned this, I think, about a year ago or 2 years ago, when they started to hear these noises, governments are focusing on where the pension funds are investing their money. They say, how much of your investments are actually in the UK? And when they say, well, actually, we're invested in Nvidia, we lent money to Apple, and, we bought some treasuries and all of this stuff. And the government say, well, hang on a minute, you're a UK pension fund. Why aren't you supporting the economy? Well, surely we've got a bit more freedom to invest where. No, and I think this is becoming clearer that the transparency that they're after means that they are going to have a bigger say as to where this money gets invested. And then you think, what are the Americans having a problem with? The Americans have a problem with, potentially money leaving the US and coming to Europe. And the Chinese have a problem with money leaving China and coming everywhere else. So actually, you can imagine there's a little bit more control over what's going on in the future. And
I remember that. I heard it from you first, and then later from Russell Napier. Financial repression is on the cards. And just to interrupt your flow here,
yes, go ahead.
Politicians always look back. They never come up with a new invention. Yeah, like the generals are used to fight the last war. Politicians are always coming up with what did work in the past. If I was a politician and not very intelligent, I would say, okay, we have wartime deficits. We didn't have a war, but we have wartime deficits. What was the last time? What did we do when we had that? We said, stuff inflation. We give you some official number. That's not the reality. At the same time, we keep interest rates at levels we like them. And that's it. And they could pull that out again. We see it already in Europe. So the next guys who do that are the Chinese, the Japanese, the Americans.
Well, the Japanese tried that actually for a long while, and now they've kind of let the balloon, for which was they were holding under the water for a while. They kind of
but with the Japanese, the inflation bit didn't work, right?
Yeah, well, that's absolutely right. But now they kind of let the free market dictate. The market's actually assessing the economy. I mean, they didn't need to hold interest rates down. The economy was pretty naff. Okay. And if you look at the Chinese are not depressing the value of their bond market. The bond market is depressing the value of the bond market because it's effectively saying, hey, the economy is not in a good shape. So the Japanese kind of figured out, well, actually, the economy is in good shape at the moment. So we've got some wage rises, we've got some growth, there's some very good signs, and yields are finding a level which reflect what's going on in the economy. And I think, that's in some respects a good thing. And then what does that mean now for global capital flows? Well, for the Japanese investor who was used to earning 2/3 of nothing by buying 10-year JGBs, had to buy some US treasuries, and then he hedged the currency for a while, and then that was a bit expensive. So he stopped hedging the currency, and then the currency fell by 10%. And then he thought, oh, now I need to hedge the currency. So he thinks, well, hang on, what have I got here? Oh, the yields on JGBs have gone up an awful lot since I was playing around with these treasuries. Maybe I need to be investing much more in the domestic economy than I was in the past, and a little bit less in the US. And I think the reality is everybody needs money. Everybody wants their own, populace to be invested in their own economy and not to support other economies. And I think, we're more likely to see that kind of restriction going forward, where perhaps we can't invest so much that we want in other stock markets without some kind of control.
What does that mean? Especially you have the example Japan now. They're still the biggest holder in treasuries in the world, right? Now, I think they're still number one.
Yeah, I guess if you include Europe as a mass, Europe I think is bigger. UK is pretty big
You
as
mean
well. But you're absolutely right.
the wonderful unified Europe, yeah, which is doing exactly what they always should do on all parts. Anyway, let's come back to the Japan. So the Japanese investors have now the realistic chance to get some yields into their own currency in their own country where the economy is doing well. What is happening if Japan simply lets their treasuries roll off and not reinvest? That would put an enormous pressure on the US bond market again, right?
In theory, yes. I mean, let's firstly divide up who is investing in US treasuries. So the official foreign exchange reserves of Japan are less likely to go down to zero. Why do they need foreign exchange reserve? For exactly that reason. They want some other currencies because they're still buying products in dollars. So they need the dollars so foreign exchange reserves for official reserves. So the holdings of US treasuries, if you like, private investors, official bodies, foreign exchange reserves being the official bodies, you'd say, well, okay, I can't see a reason right now why that should deplete. Yeah. So, you're a country, you want to buy some oil, you're going to pay for the oil in dollars. There's no point having yen in your portfolio. So you definitely need to continue to have in your, this box, this investment box, this foreign exchange reserve box, you still need to have treasuries. So that's the first thing. And then for the other people, for the pension funds and stuff, that might be a different case, yeah, where they start to look at assets in a different way. And they say, well, actually, yes, the stock market in America is growing, and it's not the only stock market that's growing. The Nikkei has been growing. So perhaps, we need to think about, replacing some of our US investments, US bonds, US stocks into our own market. If you get an economy which is growing, I mean, there's all the reason for money to find its way into that economy from the domestic investors. In Germany, I don't think that's necessarily the case, although people are looking at that and saying, well, actually, potentially now Germany are going to be sort of, flooding the market with a bit more money. Maybe that's going to be good for the economy. Maybe this defense thing is going to help the economy overall. So do I need to go and buy it? Boeing, etc., or do I need to go and buy some US assets if I've got the alternative choices here where it makes some economic sense for me to do so? And I think a lot of these decisions will be done voluntarily, and I think a lot of the decisions will be done with with some influence from the government to say, you make sure we're trying to finance ourselves here in bunds or in French OATs or whatever it might well be. And we want to make sure that a certain percentage of your investments are actually in the domestic economy. And I think that would probably make a lot of sense.
But isn't that the leper's call when the first one comes out and say, you listen, we don't call it capital controls, but by all means, it is pretty much that.
Absolutely.
Yeah? I would be the first one to get out of this country because that never ends well. Especially, you mentioned the UK. Yeah, where I still have my English television on all the time. It's hilarious. Yeah, you see the Chancellor of the Exchequer crying in Parliament for some personal reason. The bond market's freaking out straight away. Yeah, now they're talking openly about a wealth tax, and people are making off this calculation. Say, listen, 1% of the taxpayers in the UK are paying 30% of the taxes. So what do you think is going to happen if only a third of those will bugger off? You have a deep problem. You'll stay cap in hand with the IMF again. Does the IMF still have enough money? Can the IMF tell the Brits what to do, what not to do? And you're standing on the sidelines. And I saw, what was it, the UK? What's the longest bond? 30 years.
Probably they have perpetuals.
Yeah, if you look at the charts and you think this looks like it's breaking out to the top, yeah? What sign for the economy would that bring if you say, okay, one of the biggest economies in Europe still is the United Kingdom. Germany is just printing money right now. Yeah, well, we spend it on everything. We don't know what yet, but we sold it as we are only spending it into investments and realities for consumption. Yeah? And Ukraine.
Right, exactly. So in the West, we have this debt problem, and America, who up until now did not care that it had a debt problem because it didn't need to care, because unlike the UK, for example, if there is some 5 billion thing that guys want to spend some money on, they go and spend 5 billion. And if they want to spend 50 billion or 500 billion, they will also spend that money. And the bond market would not even care a hoot. I mean, it would just say, okay, go ahead, guys, because the Americans had this privilege, right? So they could do that, whereas pretty much the rest of the world could not. However, even now, you realize that the Trump administration appreciate the fact that debt has kind of got out of control. And I know you're going to say, well, if they really appreciate the debt's got out of control, why on earth did they do this tax bill, which Elon Musk says is, going to lead to bankruptcy for America? Because I think, this is only part of the issue in the States. What they're trying to do is to take some money from somewhere else. And where are they looking to take money, right? At the moment, it looks as though they're taking money from mainly, I would say, the US, the US corporates. So all these tax from tariffs. Last month, apparently, it was they received 27 billion in tax money from tariffs. Do you know last month America was in a surplus? Hello, sorry, wait, no, this is true. They were in a surplus. So they actually received more than they gave out. So now you multiply 27, and it's only just begun, yeah, because this is where Trump's going. He's looked at the number, he's saying 50% on copper. How much can we get for that? So he's actually raising money. And it's kind of ignored because everyone's saying, well, tariffs, inflation and all of this stuff. And no one's really focusing on the other part of this thing, which is actually offsetting some of these tax cuts, which were anyway. I don't care who was president, those tax cuts would have gone through because Kamala Harris, I think, already said that she would roll over those tax cuts that Trump introduced in 2016, whatever it was,
Yeah.
which Biden already rolled over. And, she was going to do it anyway. So all Trump is doing is he's rolling them over, but he's saying, right, okay, fair cop, guys, we need to find the money. So someone says, tariffs? So he said, good idea. So tariffs come in. And 27 times 12, can't do that number, say 30 times, so it's 350 billion. Then you multiply that by 10 years. That's 3.5 trillion. Well, hang on a minute. So how much was he spending on the tax bill? And then offset that with your 3.5 trillion of tariffs. Of course, over the next 10 years, the next president, if he's a Democrat, is probably going to cancel these things or do something else with them. But we have to look at the policy today. And the policy today actually is like the Brits with the wealth tax. He's saying, okay, who's got the money? And who's got the money is the corporates. Who's got the money in England? Well, it ain't corporates, is it? So it's going to be, the wealthy. So it's like, all right, let's go for the wealthy. And this is the kind of the next phase in that game where they're saying, okay, how do we plug the hole? We've got to plug the hole where the average guy is not going to feel it. And I think question whether tariffs actually reaches the average guy. We don't know. We don't know how much it reaches the average guy. That's, still to be determined. But the bottom line is they want the money and they're going to get this money and they're going to plug the hole. And this itself was one of the, I won't say fears that I had when Trump came in. I thought Trump was going to come in and do exactly that and just take the money, right? But he didn't begin this way. He began in a different way. And now he's actually sort of found a way to take the money. This is sort of government spending coming down, net. And what is government spending coming down? That is deflationary. That's not inflationary. I mean, everyone says, oh, tariffs inflationary. This is a big deflationary problem. He's taking money out the system, and in order to offset stuff that he anyway was going to give. Now, at the moment, it's neutral because he gave the money through the taxing. But you can see the direction of travel. UK, wealth tax. US, tariffs, take some money. What do you think is going to happen in Europe? Well, they're going to find a way to tax some stuff as well. So we have to think about, from an investment thing, well, how do we deal with all of this thing? Where do we put our money? And I think everybody is running down the same themes that actually, we've been talking about for the last 3 years. Well, they've been, we were early with, you need gold, you need Bitcoin, you need all of this stuff. Well, now everyone's figured that out. I'm saying, not sure now, because if you kind of think that they are going to be contracting government spend, you need to find something else where you need to put your money. And I would say we need to think about the next theme rather than running for the last train or the last thing of this current theme. Now, you know, that's the thought process I think we all need to have in
And
our
but for,
minds.
for a moment, you were just writing my long-term asset allocation, yeah, until you said the evil word deflation. I thought, yeah, what absolute sense what Nick is telling me here. Gold seems to be the reserve currency of the world, and if nobody has trust in any paper currencies anymore, I want to belong equities. I want to have assets.
Yes.
I don't actually care too much about valuation. It's real assets. I want to be in commodities now. And then you directly kick the legs away from underneath me and said, yeah, well, that's deflationary. And now my question, where do I invest in a scenario you just described where we have deflationary pulls coming in? What do I do with my money?
Well, this is a big thing because at the moment, you know, you'd say we all know what the thesis is. The thesis is, well, the government's going to inflate away your money. They successfully managed to do that in COVID. You know, we had this 20% on 10, so in the US, we had 9% inflation, but we had it for a couple of years.
Yeah.
And then debt to GDP levels actually came down. So if you look at the way that everyone's analyzing this thing and says, oh, you know, actually, guys, you should have done it for a bit longer. You should have continued this inflationary thing. The Fed should not have been sort of jacking up the rates. Let inflation actually sort of reduce the debt to GDP. So that's one way to reduce the debt to GDP. Well, the other way to reduce the debt to GDP is, you know, what is spending? Well, the interest rate that you're paying at the moment, that seems to be the biggest focus for a lot of these guys. And if you think about it, what their focus is say, okay, I need to get the interest rates down. Trump wants interest rates down 3% from where they are today. I mean, stonking if it happens, but almost certainly, you know, won't go down that far. But let's just say interest rates go from, where are they, sort of 4.5% in the States to 2.5%. I mean, that's 2% these guys are going to be saving on 300 odd 35 trillion of debt. Then you take the next thing and you say, okay, well, where else are they looking to save? Trump is not a war guy. So what was one of the themes that he talked about before he became president, or around the time he became president? He said, I'm going to talk to China and to Russia and get them to reduce defense spending by 50%. Well, you're spending 800 billion in defense. So if you cut that down by half, and let's just say you're going down to 500 billion, that's another 300 billion. You add all of this thing up and you say, well, maybe we do get the inflationary push at the last sort of bit, but what is it that the governments are trying today? They're not trying to do this inflate the debt away because they saw the impact on the people. Trump didn't get him sort of into power because he said he's going to inflate the debt away. So perhaps what he's doing is simply say, well, we're spending all of this money. The first thing we're going to try, and we're going to see if it works. He did Doge. Okay, that didn't work so fast as he expected. Going to get the defense spending, going to cut the interest rates. Interest rate cost is $1 trillion a year. You add all of this thing up, and what does that mean? Reduced government spending. What does reduced government spending do in an economy which was growing because government spending was exploding? So the first thing I think is there is actually a risk of some kind of deflationary shock if they continue along this path. Otherwise, you know, we're down to this sort of next phase where you'd say, okay, the Fed have to pump money into the system. They're going to buy, you know, do the old tricks of the past. And then that's when you want all of this other stuff, you know, Bitcoin and gold and so on and so forth. But what I'm seeing from governments is tax people, you know, do your bit to sort of create world peace, reduce defense spending, reduce government spending. That, for me, unless the economy grows fast enough, I think that's more deflationary than inflationary.
So, perpetual Goldilocks scenario, yeah?
You know, we're in that phase right now, aren't we? And you know, from these sort of charts, this Goldilocks could just drift down into the deflationary bit for a bit before it kind of peaks back. It doesn't have to sort of go all the way, and even a small little dip into deflation, it's not really that bad for markets. So, you know, I think this is a difficult steer for the US administration, Trump administration. But the way that I read it, and it's all about sequence, you know, what happens first? You know, we can all say, oh yeah, what happens first is they're going to inflate stuff away, get rid of the Fed, print all inflation. I don't think so. I think they're going to get rid of the Fed or adjust the Fed so they can get the inflation, the interest rate costs down. And, why are they sort of doing their damnedest to sort of get to a peace situation with Putin? They can't get him to cut defense spending until he stopped the war, right? And, China, he's got to be kind of, at some stage of his presidency, he's going to talk about defense spending. And I think, and it could be wrong, could just be, Nick, it's crazy. Go back to your old way of thinking. Everybody just inflates the debt away. Go and have a look at the Brits. They can't inflate anything away. They just say, we're going to spend 5 billion. And the gilt market says, no, you bloody well ain't. And so it's like, okay, good idea. We won't do that then. And nobody can inflate the debt away other than the Americans. The Americans decided, no, we're not going to go down that path yet. We're going to try something else. We're going to do Doge. We're going to do cut defense spending, cut interest costs, do all of this stuff. I think that's, and I'm always early. So I would say that's what I'm looking out for right now. And potentially that might sort of shake up the markets a little bit. Maybe that's what next year is all about. We always wonder about what could the catalyst be for a cycle to go down. And, we didn't know at the time that, it would be tariffs or anything like this. We just said, okay, but there's something bad happening at the moment. And I think that might be the thing that that is stirring the pot next year. Maybe it is, maybe it isn't. Maybe Trump just gives up that ghost and says, right, forget all of that tariff nonsense and go back to where you were, do the old taco thing, and we'll just inflate the debt away. But at the moment, I don't see that.
Well, it's actually quite appealing to me to think if we have a perpetual Goldilocks scenario, what asset do you want to have? Equities. If they are trying to inflate the debt away, devaluing their currency even more, that nobody believes in anymore, what do I want to have? Equities. So equities is actually, for the extreme scenarios, quite a good bet. Either we have perpetual Goldilocks, and that what you just explained happens. Economy is growing, but no inflationary pressure whatsoever. Good, you want to be invested in high betas even. Just have them lying there. Cool, economy will grow. Or if they do the usual thing, which most likely will happen because printing money is easier than not printing money, right? And inflation is lifting its ugly head again in terms of they don't trust the currency anymore. You want to be invested in equities as well.
Well, I mean, equities also have a story today of why are earnings growing so quickly, and you could argue this is the capex cycle of the new technology which everyone's spending money on. So if you imagine that at some stage in the next few years the government say, oh, by the way, defense spending down over the next 5 years by 50%, already then people who start to question the level of capex spending, and that might sort of cause some wobbles in the equity market. So I don't think equities necessarily are a one-way bet, but I mean, it's certainly, the idea behind all of this thing, has some credibility. But in the near term, you do start to see some question mark over the, what are the side effects of some of the policies that we've seen already. So there are some, it's for the first time, I speak about, you wonder whether the labor market really is strong enough. Therefore, you wonder whether the consumer spending cycle will continue to go the way that it's been going. So if you look at those things, you might say, actually, outlook, there are some cracks beginning to emerge in the economy. And whilst the Fed, who don't see anything, are just sitting on their hands playing some political game, you could well get a reduced growth in the economy, which is also going to sort of question some of the themes of, oh dear, then why is Meta spending so much money on capex, on AI stuff, if the consumer is not spending money, and so on and so forth. So there are sort of things that the government have to do along the way to put a floor on the economy. And at the moment, you don't see any things that are working towards that. So, that's one piece of their plan that I think is still, hasn't convinced me that they're doing their bit.
So let me have the final question, and then we went through the economy, we went through interest rates, we started with Bitcoin, we had gold here. Gold, again, sorry to bring that up. We have a consolidation phase at the moment, and we saw the top interims quite well. It's all in the videos. You can check us out, what we were talking about. Where do you see it going from here now? Because there are the first YouTube videos showing up again that the revaluation is just minutes away, that there are already secret plans to say, okay, our gold reserves, gold is now at 20,000 US dollars. Is that complete BS, or do you think that that could be a surprise move?
I think timing of this thing, I would be surprised if they do that before they control the Fed. So I think that, that is likely to happen. Yeah, because this will be yet again another great thing for the bond market to say, what's the bond market thinking about today? They're still following the stories we spoke about 3 years ago. Inflation and all of this stuff, and debt growing and so on and so forth. Well, if you think about it, cutting spending, tariff income, surpluses, thinking about defense spending, revaluation gold, and then suddenly everyone's going to be saying, "Oh, got to buy long bonds, haven't you?" And somewhere the themes would have been totally reversed. And I think that may well be part of that story, but I do see the US going down this path. I think that's because they want to use their gold for good reason. Judy Shelton has been talking about who is going to be she's a candidate to be on the board. I'm not sure she becomes the head of the Fed, but Judy Shelton's been talking about going to a 50-year or 100-year gold-backed treasury bond. Clever idea. And you can't do that with $35 an ounce. So you've got to get this thing up to a reasonable level. And I think the American government want to use their assets much more clever. So they want to use the asset side of the balance sheet much more sensibly than it has been ever used in the past. Gold has just been stored in a room, right? They have Fannie Mae and Freddie. They want to sort of privatize these institutions. They want to sell farmland. They want to take it away from the Chinese. They want to sell this stuff. They want to find a way to get the debt down. That's their focus today, in my view. And I don't see anything any other way. Gold, it's still being bought by the central bank. So there is a lot of flow. I actually assumed that we were in, from Elliott wave, there's a 3-wave correction. This 3-wave looks like it's morphing into a sideways pattern called a triangle, which could still mean that gold continues to rally in this kind of phase. And therefore, and we see the last rally in gold. The target on gold was 4,000. Target on gold, could be 8,000. It's going to be either 4 or 8. Don't know where it ends up, but gold still looks like it's going to be part of that discussion. How that fits with the kind of deflation idea, I don't know. Not everything in my sort of mind works correctly without question, but that one I can't see at the moment anything which is pushing gold more negative.
Thank you, Nick. Our viewers have seen a lot of opinions right now, and I love to ask this question. So if you show me yours, I'll show you mine. Where are you invested at the moment? Long, short? Just one sentence.
So I was extremely long in April. So I bought everything whatever cash I had.
Yeah, you said it on record. Yeah.
Yeah. And I have in the last week started to unwind. The only places I have not unwound, it's reduced. I still have positions in gold miners, silver, and all of this stuff, but they are vastly reduced. I still have exposure to China. I have growing exposure to emerging markets and to Japan. Europe and US, I won't say I'm out, but I'm less exposed.
Thank you. I'm playing a tactical at the moment. I opened up my beautiful strategy. I've propagated that on this channel for years now, and it bloody every time worked. This is, by the way, not a trade recommendation, either from Nick nor from me. When the market was taking out new all-time highs and volatility dropped, I simply put on a long straddle again on the market, which cost me carry. It eats every day tiny bits away from me. So what did I do on the other side? I sold puts on the VIX to finance that carry. At the moment, the VIX trade is slightly in the minus, but the straddle is surprisingly nicely profitable, even though I was expecting the downside to kick in. Well, the upside did it. Who cares? It's working, and if I start losing money on the VIX by selling downside puts, I'll just open it up again, because there is natural built-in floor somewhere in the VIX. If we are at 10, well, I'm mortgaging the house and start selling 10 volatility, because we've only seen it a few times in my lifetime that it was below that. Anyway, that's all from us for today. One final plug, if you have been here for the whole time, I'm planning the next option and macro bootcamp on the 19th, 20th, and 21st in September. Nick just told me earlier he will be there again. I'm making an official announcement, but for everybody who was in here, that's when it's going to happen. If you're interested, send me an email, go to our website, and this will be the last one, at least for a year, in German, because we get so much, well, people writing in, calling in English, asking me, can you do it in English? Your English seems to be quite reasonable, even if your German accent is horrible. So I thought, yeah, well, fine. You come for the options, you stay for the accent. So if you're interested, September, I'll announce it. Next option macro bootcamp in Germany, because I live in Germany. I'm not traveling the world. I'm paying my taxes here. I like my country. That's why we're doing it here in Germany. Nick, thank you very much. Any last words?
No, I think I said an awful lot.
You did. Thank you very much for that. Bye-bye.
See you. Bye-bye.